You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
An interesting week, an interesting day on the markets.
Oh, yeah. Yeah, the problem, I guess, if you want to look at the main hit was to European investment in commercial banks. They just really got hit, 35% fall since December kind of thing. And big names, Credit Suisse, Deutsche Bank, enormous hits, and just became one way. And when we published on Wednesday, the amusement was whether the hit in bank stocks in Europe would end on a black someday, because when Shanghai got hit in August, the worst day was August 24th, and they called that Black Monday. So, and I think what happened, that was about the worst day the Tuesday was. So I don't think it was a Black Tuesday. I think it was more like a Gray Tuesday, but it was very bad, very ugly stuff. And again, with weak crude oil prices. And on our technical work, we had levels at the Keltner band that crude could hit, and it hit them more or less overnight, and we're getting quite a rebound out of this. And we're thinking that, we've been talking for some time now that crude oil can have an important seasonal low sort of around January. And so this one got pretty heavy and ran until recently, but it looks like it's trying to do a double bottom in here. They had the low in January, rebound, and then a bit lower recently, a test of it. So it hit the target on the Keltner band on the low side and is rebounding. Seasonally, I think this rebound can run for a number of weeks, perhaps into March. It just depends on how impetuous it is. The first move has been explosive because a lot of short covering there, and but generally it could run into, as I say, March would be an initial target, and then when we get to there, we'll take another review on it. This will help out the base metals, which can also have a seasonal rally out into March. And we were looking at the grains and GKX the other day, and they haven't been hit too hard, so I just sort of thought that maybe a little decline in there, a clean out would set it up for a rally. So we could have the basic commodity groups recovering into March, which would help a whole lot. The U.S. dollar index, the DX, on the last rush a couple of months ago up to 100, got somewhat overbought, backed off a bit, turned around, and then in a couple of attempts to rally, couldn't get through the 99 level. So then our work, at least my work, we thought maybe it could drop down to 97, but it's dropped down to about the 96 level, a bit below and a bit above, which of course then really helped the gold market, which was oversold. Gold itself was recovering, and then boom, this week, terrific rally, just wow. And people are sort of, saw stories about lining up to buy bullion and everything like that. So it gets impetuous where people are afraid. Things are beat up so badly you get afraid of it. And then all of a sudden it clears and away it goes. Our view on it, at least, was that the gold shares relative to crude have been improving since November, and it was then we advised accumulating some gold shares on weakness, and then we had the really good rally right up, and then the hit in January to the big stock market took them right back down to those lows again when the advice was to accumulate some more. We're not fully invested yet, but hey, it's acting pretty good so far. Over on the credit markets, the latest weakening in the general stock markets and particularly the bank stocks, it was anticipated by credit spreads widening yet again, and also the yield curve flattening. That's the difference between short-dated treasuries and long-dated. And that, when we go back to looking at back in June, the credit spreads did narrow in, and we thought that they were getting geared to go out widening, and there would be a serious widening. And also at about that time, the steepening trend in the Treasury curve had got overbought, and it would turn. So both of those reversing, spreads to widening and the curve to flattening, would be a negative for the bank stocks. So that's where we came out with the quip that bank stocks were a really nice, safe widows and orphans short. And then the recent collapse got away ahead of itself. So I think that we should all be watching the yield curve and credit spread and paying absolutely no attention to what the central bankers are saying. And the reason for that is because the central bankers are typically months behind the change in market rates of interest, and which is the case with that ridiculous slight increase in the Fed funds rate. It's all meaningless behind the scene, everything else. So if one was looking at the curve and spreads, then you can get the turns right in the stock market, so which is it's very pleasing.
Now, OPEC has finally said it may cut back production, say 5%. Analysts are saying, well, that would boost the price, say $4 or $5. And with the difference in the currency, that could be a nice boost for Canadian producers who are probably suffering the most or amongst the most in the world. Any thoughts on that, Bob?
Oh, yeah. I think it was a desperate move by OPEC, but the crude oil had reached their targets on the downside, oversold at a target, and was due for a bounce. So that somebody then in OPEC came out and said something gives them rather good timing. But it's not OPEC doing anything that's turned the crude market up. It was got oversold. It's the same as at the top. This goes back to the second quarter of 2014, when then our view was that the rally in crude could top out somewhere around May or June, and then it would head into a serious cyclical decline. And that was, we wrote it up, that this would follow what was going on in natural gas, which had gone into, let's call it a new regime, and at a much lower price level. And you had the old game in crude oil was to focus on troubles in the Middle East, which put an artificial premium on crude oil. And so then you had the fracking come in, because it was natural gas was more eligible to fracking early, and also it's more of a North American market. So it set the precedent of dropping down to a new, distinctively low price range. And of course, this is what we were looking for in crude oil, a post-bubble contraction. Most commodities are weak, and that crude oil would get in line with natural gas. And then once the crude really started coming down, then you had, the journalists and reporters have got to write something. So then they come up with this idea that the Saudis were concerned about all the new production coming out of fracking and tight structures in North America, and that they were lowering the price of crude in order to eliminate that sort of production. Well, this is stuff dreamed up by somebody at OPEC and somebody who was a reporter. And it wasn't the whole story, and in looking back on it, was that crude oil is in a post-bubble contraction, and it fell in line with weakness in other commodities. So the Middle East premium came out of it. So it was all made sense as it was happening, and it makes sense now that it's over. But again, you've got this idea that specific policy moves can change markets. And sure, it's easy for some OPEC guy to come out and say, oh, we're going to slow down production and the price will go up, but the price was due for a bounce.
And of course, as you said, it's only talk of cutting production. Right now, Saudi Arabia has increased its production. Nigeria has really boosted their production, and so has Kuwait. So talk is cheap. We'll see if anybody actually puts their hand on a valve.
Well, the other one we put on was that in previous post-bubble deflations, weak grain prices prompt the farmers to plant from, as the saying goes, from fence post to fence post. They plant as much as they can because the price is weak, therefore they got to grow more of it in order to keep their income coming in. Well, then that's what we also at one time threw out on crude oil, that the industry would be effectively planting from fence post to fence post, or drill hole to drill hole. And that's, in a post-bubble deflation, this is what drives things. You've got to produce as much as you can, an individual producer, in order to maintain your cash flow. So it's a post-bubble deflation is a real grinder.
We'll have more with Bob Hoye after the break, and we'll answer one of our listeners' questions.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with market historian Bob Hoye. One of our listeners, John Law, has written us an email question. Bob, I have followed your analysis for years, specifically your teachings of the role of gold in a post-bubble contraction. I understand how lower input costs ultimately will fuel the gold miners. However, in today's demonetized fiat currency system, please explain the mechanism of how gold will reliquefy the banking system. I understand Exter's pyramid, and that gold is money plus credit, gets destroyed in a post-bubble contraction. But what does gold have to do with the banking system anymore, since we are in a fiat system? And how does gold reliquefy the banking system in the modern world?
Well, that's a very astute question, because the financial world is crazy ever since these intellectuals thought that they could arbitrarily manage an economy, which is utter nonsense. But anyways, the key question is, how does the gold come into the equation and reliquefy the banking system? And this is the way it seems to work. It's a rough explanation that I've been using for decades, is that in a credit bubble, you have a huge expansion of the normal instruments of credit. You also have the invention of all kinds of weird credit instruments. And then once the party's over and the prices of things that have been speculated in goes down, then Mr. Margin gets to work and starts to force everybody out. So the normal instruments of credit will contract, and of course all the fanciful ones will just disappear. So then that tightens up the banking system, naturally. We also keep seeing articles about the long treasury market. There's no liquidity there, and so the liquidity and things is disappearing. So this liquidity is, as credit instruments contract or disappear, naturally tightens the system. But then Mother Nature knows how these work, because she's been around for a long time. And then the real price of gold goes up, which it has been, particularly relative to crude oil. I mean, this is that record, gold divided by crude oil. So then that prompts more profitability in gold mining. Production rates go up, and eventually the gold gets into the system and starts to reliquefy as the contraction for the normal credit instruments is going on. So it's an ongoing thing. I think it'll happen yet again, and certainly if you take crude oil as a proxy for energy costs in gold mining, it's incredible. So somewhere the profitability should begin to appear in the gold side.
Well, I also saw a chart that we used to think that the break-even point for gold was $1,100. Some have put that as low as $860. So gold producers who have relatively healthy books are making money right now.
Oh, yes. Yeah. But but you want also, there was so much bad business done in the gold industry on the boom to 2011, and the big guys are still writing that stuff off. So you got to get all that cleared out, and then mining analysts can start looking at operating cash flows and as their profitability improves, and it's going to be exciting times for the gold sector.
Gold miners or gold bullion?
Well, I always prefer the miners because this is an investment game where you have earnings improving, and whereas if you buy gold right, you can make some money out of that, but prefer to look at gold as an insurance position and to buy gold shares as an investment position, because in the move, if you're not leveraged on either, typically in a bull market for the sector, gold shares will make more money than gold. And besides that, sometime in the future, the public may force the U.S. and other countries to go back onto a gold standard, in which case you got no change in the price of gold, but profitability does vary. And so the main thing, investors should be looking at the prospects of improving profitability for the next number of years, and we think that this is the start of a cyclical bull market for the gold miners.
The Canadian government has been dumping its physical gold like crazy lately. Why would they do that, especially if the price of gold is expected to go up substantially?
Well, they had so little left, and when they were very ambitious sellers, there was a concerted bear raid on gold that drove it all the way down to, 241 or 243 or something like that. And that was when the Bank of England sold the last. So Bank of Canada was a patsy on that one. They got in a league with all these other idiots who don't like gold as a reserve. And I note that in the press release, or the discussion about it, that the Bank of Canada would be buying long bonds in their reserve account, and because they'd get a better income out of it. So what are they doing? They're selling gold at a very low price, and they're buying bonds at unbelievably high prices. So, hey, what would you expect out of a committee?
Yes, the government always handles finances so well.
Yeah.
Yeah. Bob, thanks a lot for chatting with us.
Yeah, Jim, good to be with you.
Have a great weekend.
You too.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.